Hello and welcome to Switzer Investing Insights, brought to you by nabtrade. And today we want to look at a very, very important subject, that is, how do you play the coronavirus scare? Paul, how do you start off?
Well, before we get to that, I think it's instructive to look at just what's happened, Peter. So let's just go back to February, where we saw the market lose about 8%, 7.7% in price terms. So year to date, we're down, and I think we all know on that. What's interesting, Peter, as we move on to the next slide and just look at the different components of the market, this tells us something what's going on.
Yep.
The top 20 have actually done a little bit better, and I think that's a function of they've got the liquidity. People sell those first, but they also buy them back first. The mid-cap 50 and the small ordinaries, they're the smaller stocks, will struggle, and I think that's a way to look at the market as you when we've got a scare, and perhaps a very real scare with the virus and so forth.
Yeah, and you make the point, Paul, don't you, that because they're bigger, they're easier to sell, they're very liquid, but when they get, in a sense, creamed, there are a lot of people who want to buy them.
That's right. That's where the liquidity is. So when the market sells off, they get hit the hardest, but they're also the first things bought back. So whereas the smaller stocks tend to get left behind, they can just lag. Sometimes they'll get sold down, but there aren't any buyers when it bounces. So you've got to be a bit careful on some of the smaller cap stocks.
Let's go to sectors now.
And I think the sectors also tells us a couple of things. First of all, the sector that had the most damage in February was the IT sector, and that's a sector that's done the best. So probably not surprising, trading at the most elevated PE multiple. When markets change sentiment, they go the hardest. But also look at the sectors that are actually up still on a year-to-date basis. And I think the standout there is the healthcare sector. Now, you could argue the virus might be good for companies like CSL, but there are other companies in that sector, things like ResMed and Sonic, that are doing pretty all right. I think people are saying these are stocks I really want to own. Obviously, the sectors, the so-called defensive sectors like consumer staples, real estate and utilities aren't doing too bad, partly a function of the cash rate then being eased in March, because people can see that they're yield-based sectors, but resources and energy get hit hard, and that's what you'd expect when people are getting really concerned about growth.
And when you think about, Paul, energy, IT and materials are all internationally focused businesses as well, aren't they? And it's the global economy that's being challenged.
The global economy, they have no control over, particularly in the energy, about the oil price or the commodities price. If people get very bearish and think growth is going to contract, commodity prices fall, those stocks get hit. Okay.
Now let's look at another important issue, the history of epidemics.
Yeah, I think this is really instructive as well, Peter, because before we talk about how you play it, this chart actually looks at some research that looks at the epidemics and what they've done to stock markets since 1970.
Yeah, it really grabbed me because when the coronavirus came out, I looked for, well, what is the history of this? Because you don't kind of study this at university. And I looked at it and I was quite staggered to see that the actual fall in the stock market was quite small in terms of the arrival of something like SARS or the Ebola problem or whatever. But look at the kind of comeback that comes after it. And it's not all driven by the fact that the epidemic is over. Other factors like government spending and interest rate cuts power the market up. But the trend is up, isn't it?
Yeah, what the data shows is that on average, over 3 to 6 months, markets are up, higher than where they started. Yeah. So there are all the epidemics, the black dots, and I think there's 15 or 16 of them listed there since 1970, but markets do go up. So I think that's instructive as we talk about how you can play the current market scare. So let me make a couple of points. First of all, Peter, I don't think this is the end of the bull market. I think it's important to bear that in mind. This is a correction, but the bull market trend is still intact. And typically, we need a drop of more than 20% to signal the end of a bear market.
And it will have to be a sustained drop over 20, because at the moment computer trading is making it much more volatile than ever before.
Yeah. So I still think that means you play this as an opportunity to buy, an opportunity to buy particularly in dips. Now next, I'd say, look, just buy quality. Now think about the stocks that have always been too expensive, you've wanted to buy but haven't. They're the stocks to try to buy in the fear where others are selling, right? So you've got to use the opportunity to buy those stocks that you always wanted to buy. Remember, quality stocks, they will generally move the fastest in both directions. I made that point up front. They'll be the first hit because that's where the liquidity is, the only thing that the market can get set in volume, and they'll bounce the hardest on the way up because, again, that's where the volume is, and people will want to get back into them, right? On the small cap side, I think you've got to be pretty careful because volumes can be very low and they can gap very quickly. So if you want to get out of small cap stock or you want to buy a small cap stock, don't be too precious. You may have to pay the price. So that means, if you're looking to sell, you might have to hit all the bids to get rid of the volume. Don't expect just by putting an offer out there, someone's going to take you out. It doesn't work that way when volatility.
You don't have power when you're a seller into a collapse.
And conversely, you want to buy it, there may not be a lot of volume, so you need to actually pay the price to get set.
Yep.
Into rallies, I think that's the time to think about selling the unloved stocks. And look, I think finally, Peter, we don't know how long this is going to last. No one does, and it could last some time. And our assessment this might be a lot worse than we're perhaps making out to be. But what I will say is that the market is likely to work out when this is all over a long time in advance of when the government or the health authorities say it is.
Yeah, the announcement factor could be, because there's political aspects to this, but I know there's a bond fund manager out there who's got all his high-powered PhD staff that usually look at the money markets. They're currently watching infection rates and death rates in places like China, South Korea and Italy, and when they start seeing the trend moving in the favour of optimism or no more pessimism, they'll be moving in the markets, and the markets therefore will tell us in advance what's going on.
Yeah, I mean, markets are preemptive. They'll preempt something. They're thinking about the future. I can assure you that there's lots of money waiting to say,
time to go.
Time to go. But we could be in this for months. Yeah. And but I'm just thinking that the caveat, the signal here will more come from the market as opposed to the government or authorities.
And as Warren Buffett said, be greedy when others are fearful. That's Switzer Investing Insights, brought to you by nabtrade. Thanks for joining us.